CORZ just reported a net loss of $1.16 billion for the quarter ended June 30th, 2026, on revenue of $164 million. The loss is 7 times the revenue. And in those same 3 months, gross margin went from 6.4% to 42.7%. Both are true. Here is the bridge. Operating loss for the quarter was $78.5 million. Net loss was $1.155 billion. The gap is just over $1.07 billion, and almost all of it is one line below the operating line. Change in fair value of warrants and contingent value rights. That single line is $1.046 billion, 90.5% of the net loss. It is non-cash. It is a mark-to-market on warrants issued when the company emerged from bankruptcy in 2024, remeasured every quarter against the share price. Because the warrants are a liability, a rising stock produces a larger loss. Run the series and it inverts. In the first quarter of 2025, the warrants fell $634 million, and CORZ reported net income of positive $580.7 million. 1 quarter later, they rose, and the company posted a $936.8 million loss. No business swings $1.5 billion in 90 days on operations. The company's own earnings per share disclosure makes the point. Because the penny strike warrants sit inside the basic share count, the filing adds part of the warrant charge back. So that $936.8 million loss became 4 cents a share. 4 cents. So where did the margin come from? Not from mining improving. One segment replaced another. Colocation, which is leasing power and data center space to AI operators, went from about $11 million of revenue to $137 million. Self-mining fell from $62 million to $22 million. Colocation was 13% of revenue a year ago. Now it is 83%. The gross profit split is starker. Colocation went from $1.1 million to $80 million, a 59% margin. Self-mining went from a $2.8 million profit to a $12.2 million loss. Colocation alone produced more gross profit than the whole company reported. Sit with that. Bitcoin self-mining is now gross margin negative here. The machines cost more to run than the Bitcoin they produce is worth. Management is winding it down, and hosted mining ends by December 31st, 2026. Getting out is not free either. A $41.9 million loss to terminate the mining equipment supply contract. The colocation economics are cleaner than 59% suggests. $35.1 million of that revenue is power fees, and the filing shows power cost at exactly the same $35.1 million. Power passes through with no markup. Strip both sides, and $101.6 million of license fees carries $21.6 million of cost. Here is the meter that drives revenue. Billable customer power capacity: 120 megawatts at the end of last year, 225 in March, 395 at June 30th. 590 megawatts are under lease, so nearly 200 more are still being built. That gap is growth already signed. Value it per megawatt, the only way that makes sense. $80 million of colocation gross profit on 395 megawatts is about $0.81 million per megawatt per year. Hold that flat. If only the CoreWeave contract ever bills, implied value is roughly $2.50 a share. Add the AMD and NeoCloud leases signed in July, and it is about 15. Lease everything, and about 23. The stock closed at $18.12. 2 risks, both large. The filing states the first flatly. Our colocation revenue is currently derived entirely from a single customer, CoreWeave. That is 100% of the segment. That is 83% of revenue. The second is dilution. 182.7 million potentially dilutive shares against 319.6 million outstanding. Core Scientific's income statement is a poor instrument for measuring Core Scientific. Watch billable megawatts, not net income. Nobody wrote this by hand. Every number came out of the filing's own XBRL. And the same pipeline runs on any of the 10,000 companies that file with the SEC. This entire analysis was built on the RoboSystems SEC shared repository, structured filing data for every public company that files. Revenue, earnings, balance sheet, cash flow, segment breakdowns, all queryable, all from the original XBRL. If you want to run your own deep dives like this one, the link is in the description.